Hello everyone. Today we are going to discuss about cost and variance analysis. Actually, our topic is variance analysis for the today class. Please remember in CMA part 1 we have 2 units. Unit 15 is about cost and variance analysis, and unit 16 is about responsibility accounting and performance measures. So overall, these two chapters, these two units, 15 plus 16, are known as performance management section. Okay, and this is your 20% of your exam. It is really important. So here we go. We are starting with unit 15 today. And in unit 15, under variance analysis, we have the following list of topics. We have 15.1, it is about variance analysis overview. 15.2, it is about static and flexible budget variance. 15.3 is about direct materials variance. 15.4 is about direct labor variance. 15.5 is about mix and yield variances. Then 15.6 is about overhead variance. And then we have here examples. And then we have here sales variance. So let's start now. So here we go. First of all, we are going to discuss about the definition of variance. We need to understand what is the variance. So guys, variance actually is the difference. It is always the difference between amount budgeted and the amount actually incurred. Okay. It's simply a difference between budgeted values and actual values. But there are two types of budgets are there. So that is why we have to understand two definitions of variance. So which budget we have to use here? So there are two types of budget. One is called static budget and second is called flexible budget. Okay. So here we go. So what's the difference between static budget and flexible budget? So guys, static budget, please remember this budget we always prepare at the start of budget period. This is also called sometimes master budget. So we prepare at the start of the budget period. Okay, usually at single activity level. Single activity level means let's assume if you are a car manufacturing business. So if you are planning that you will produce only 2,000 Land Cruisers, okay, in 1 year time, in coming year. So here this 2,000 activity level is called single activity level. There could be a multiple activity level also. Like what would be the budgeted amounts if I will produce 1,800 Land Cruisers? What will be the budgeted values if I will produce 2,000 Land Cruisers? Or what will be the budgeted amounts if I will produce 2,200 Land Cruisers? But here, under static budget, our activity level will be single. We will take only single activity level. And then we will prepare the budget. So that budget is called what? Static budget. So in simple words, in static budget, what you will do? This is really important, which I'm going to highlight. Whenever you will produce static budgets, so you will always take budgeted activity level, means budgeted production or budgeted units of output. We will take budgeted activity level and we will multiply with what? With the budgeted cost. For example, if it is material cost, so we'll take budgeted activity level multiplied by budgeted material cost. If it is a labor cost, we will take budgeted activity level into budgeted labor cost. If you are calculating sales, so you will take budgeted activity level multiplied by sales, budgeted sales per unit. Budgeted. So it means under static budget. So we will always have budgeted activity level. Under static budget, we will always have budgeted activity level and we will multiply with what? With the budgeted cost or budgeted sale price. So this is how you will produce the static budget. I'll show you the example, don't worry. Let me just explain the mechanism. Then we have here flexible budget. Flexible budget, guys, in whatever definition I'm going to tell you here right now. So actually in British-based studies, flexible budget is slightly different concept, but under American-based budget, flexible budget is kind of different concept. But please remember, flexible budget, which I'm going to explain now, in British syllabus, it is called flexed budget, not flexible. In British syllabus, it is called flexed budget, but in American syllabus, it is called flexible budget. Because flexible budget is slightly different under British studies. So that is why please remember, if you are a student of any British study, so you should remember I'm explaining now flexed budget. For CMA USA, you should assume it's a flexible budget. So now you have to understand what it is. Flexible budget, this budget we prepare at the end of budget period. For example, maybe the budget period was 2024. So it means at the last day of 2024, okay, so we will prepare this budget. But what will be the difference? Here you will use actual activity level, not the budgeted. For example, because by the end of, let's assume, budget period, you will get the actual units which you have produced or which you have sold. So we'll take actual activity level, but we will multiply with what? With the budgeted cost or budgeted sales price per unit. So it means flexible budget, what's the difference? We will use actual activity level multiply by budgeted cost or budgeted selling price. It means the activity level is the difference. Under static budget, we use budgeted activity level, but under flexible budget, we will use actual activity level. Understood? So this is called amounts budgeted. And I hope so you understood. In static budget, you have to take budgeted activity level, multiply by budgeted cost or budgeted selling price. But when you will produce flexible budget or flexed budget, so then we will use actual activity level multiply by budgeted cost or budgeted selling price. Understood, guys? Now we have here one more definition, which is called what? Actual results. So this is what I told about. I told you about what? Amount budgeted. Okay, so there are two budgets, static or flexible. So we'll study later which budget you have to compare with the amounts actually incurred. Now the point is that how you will get the actual results, which is also called amount actually incurred. So what you will do simply, whenever you are talking about actual results, so you will always take actual activity level, because actual results you will get by the end of the budget period. So there you will know what is the actual activity level, what is the production. You will always multiply with the actual cost or actual selling price. So this is called actual results. Now I'm going to tell you a difference. So it means we have here now, then I'll explain, don't worry. I told you we have a static budget and here we have a flexible budget. And in between, I'm just writing, for example, actual results. If I will compare static budget with the actual results, this is also variance, because variance is the difference. If there is any difference between static budget and actual results, this is also variance. But this variance is known as static budget variance. On the other hand, if you will compare flexible budget with the actual results, this is also a variance. But this variance is known as flexible budget variance. So it means there are two definitions for variance, static variance and flexible variance. I said what? Variance is simply the difference between budgeted values and actual values. But in budget, we have two types of budget. We have static budget, we have a flexible budget. When you compare static budget with the actual results, you will get static variance. And when you will compare flexible budget with the actual results, you will get flexible variance. Okay, so now here we go. Let's practice now the example how to produce static budget, flexible budget, and actual results. So definitions are written, guys. Okay, actual results are also defined here. What is actual results? You will take actual activity level into actual cost or actual selling price per unit. And obviously we get this data at the end of the budget period. Now guys, here I'm going to talk about, there is a one concept which is also known as standard cost. What is a standard cost? Standard cost are the estimated cost of the unit. What it is? It is the estimated cost of the unit. For example, let's assume you are the production managers, okay, and you have a 10 years experience in manufacturing the chairs. If I would ask you, what would be the cost of chair in the next year? So obviously you can estimate very easily. The reason is that you have experience, right? So the estimate cost of the unit under predefined working condition. Predefined means, you know, for example, if this type of labor you have, this type of material you have, this kind of, for example, machinery you have, then how much, what would be the estimated cost of the one unit? So that is called standard cost. Understood? So standard, don't worry, you don't need to worry here about this. Standard cost will always be given. Okay, it's estimated cost. Understood? So you can also say like it's a kind of budgeted cost. Okay, so here we go. Let's do one example. So how it will work. So we have here one example here. For example, standard cost per unit. Standard cost means say budgeted cost per unit, and standard sale price means say budgeted sale price per unit as follow or as follow. It is given. For example, this is the standard cost per unit. For example, let's say you are manufacturing a chairs. For each unit of the chair, for one unit of the chair, okay, what is the cost? It will be available in the question, don't you worry. So as it is given here, so similar way it will be available. For example, for each chair per unit, per chair. So we have a material cost, we have a labor cost, variable overhead cost, fixed overhead cost. For example, for each chair, we need 5 kg of direct material, and the rate is $10 per kg. So 5 kgs are required. Each kg is having a cost of $10. So 5 times 10, it will give you material cost of $50. Then for example, we have a labor cost. For example, for each chair, we need 3 labor hours to complete that chair. And we are paying $15 per hour to the labor. So 3 hours times 15, it is a $45 is the labor cost. This data will be available in the question, don't you worry. Then we have a variable overheads. We are assuming here variable overheads are based on labor hours. So same, we have a 3 labor hours. And for variable overhead, what is the rate? Rate is $6 per hour. So we have here $18. This data will also be given in the question. Then we have a fixed overhead. Fixed overhead per unit we need. For example, our annual fixed overhead is $10,000. And in 1 year, we are planning to manufacture 1,000 units of chairs. So 10,000 divided by 1,000 units. For example, you have a fixed cost per unit is $10. Understood? You know, when you calculate fixed cost per unit, you need total fixed cost, fixed overhead divided by total units. Because it is the budget, so this will be estimated cost. This will also be estimated units. Understood? So for example, it is $10 per unit, and this is our standard cost per unit. If I will add all these values, so this is our what? Standard cost per unit, budgeted cost per unit, or estimated cost per unit. Now here we have here some other data in the question. For example, we have here budgeted sale price. It is also called standard sale price per unit is $200. And the budgeted units are 1,000 as we took it here also. This is budgeted units 1,000. Then company actually sold 900 units. This is the actual activity level. Actual activity level is 900 units. Budgeted activity level is 1,000 units. Okay. Now let's assume our requirement is we have to produce static budget, flexible budget, and actual results. Okay, so here we go. For static budget, first I'm going to explain. So guys, how you will produce static budget? Don't forget the formula for static budget. For static budget, we always apply the formula static budget. We always take budgeted activity level into budgeted cost per unit or into budgeted selling price per unit. So this is how static budget will work. So budgeted activity level is given here 1000 units. So it means 1000 units every time we will multiply. So that is why static budget we always prepare at the start of the period and at the budgeted activity level, which is 1000 units. So now how budget will be prepared? For example, you are preparing maybe budgeted income statement, let's assume. So we will write first here sales. How many budgeted units are there? 1000 units, we know. And what is the budgeted sales price? Budgeted sale price is 200. So 1000 units times 200 units. This is going to give you a budgeted static budget sales. Then you want to get, for example, here cost. And we have a different cost. We have a cost of material, cost of labor, cost of variable overhead, cost of fixed overhead. So what I'll do, if I want to calculate material cost, I'll take this is the budgeted cost and I will multiply with the budgeted activity level. So 1000 times 50, it will give you material cost of 50,000. Then I want to produce labor cost. What I'll do, I'll take budgeted labor cost, this is the budgeted cost, and I'll multiply with the budgeted units, which is 1000. So 45 times 1000, this is going to give you labor cost of 45,000. Then if you want to produce variable overheads, I'll take this is the budgeted cost for variable cost. This is variable overhead. And I'll multiply with this same budgeted units. So 18 times 1000. So this is going to give you 18,000. Then I want to calculate fixed cost. So fixed cost is given here. Here it is given total fixed cost. 10,000. So I'll deduct here 10,000. Okay. So now if this is my all total budgeted cost and this is my budgeted sales. But from budgeted sales, if I will deduct budgeted cost, so this is going to give you profit or loss value. So far here we have a profit of 77,000. Okay. Now let's assume we are going to produce flexible budget, which is called flexed budget in British studies. So how you will produce, please remember, for flexible budget, we will always apply this formula. We will always take actual activity level into budgeted cost or budgeted selling price. So if you will look at here, the difference is activity level. Here we are going to use actual activity level. And actually company sold 900 units. It means 900 units we will multiply with the budgeted cost. For example, if I want to calculate, it means if I want to calculate flexible budget now, and I want to write sales value. I want to write sales value. So I'll take actual activity level, which is 900 units. And I will multiply, this is the actual activity level, right? And I will multiply with the budgeted selling price. And budgeted selling price is given in the question here, somewhere here, 200. It is given here. Right? 200. So this will give you sales value, 118,000. 180. Then I will deduct a cost. I'll take, for example, if I want to write material cost, I'll take actual units into budgeted material cost. Actual units are given here 900 and budgeted material cost is here. So 50 times 900. So this is going to give you material cost of 45,000. Now if I want to calculate labor cost, labor, I'll take actual output, which is 900 units, and I will multiply with the budgeted labor cost, which is 45 here. You can see it is the labor cost. I'll multiply. So 900 times 45, This is going to give you 40,500. Now I want to write about variable overhead. So what I'll do, I'll take actual output again, which is 900, and I'll multiply with the budgeted variable overhead cost, which is $18. You can see it is a variable cost. I'll multiply. Okay, so this is going to give you how much? 16,200. Now, please remember here, when you will write it here, fixed cost, whenever under flexible budget, you would write fixed cost. Assume we will write same fixed cost which we have written under static budget. Do not do here, please don't do actual activity level 900 and the budgeted cost was 10. It is something like maybe 9,000. No. So please remember, so fixed cost, when you will write under flexible budget, we will write same cost which we have written under static budget. The reason, what's the reason? Maybe you're thinking why. The reason is that, guys, so fixed cost, we assume it will not change with activity level. So that is why we should write the fixed cost, same fixed cost which we have already written under static budget. And under static budget, do you remember, we have written fixed cost of 10,000. So same fixed cost, we will write it here. Understood? Okay, so now this is all your cost. This is all your cost. And this is your sales revenue. So if I will deduct revenue minus cost, so this is your profit and loss value. This is what flexible budget. Understood? Now, guys, here we have here actual results in between. Actual. For actual results, there is no data because actual data is not given here. Like actual material cost is not given in the question. Actual labor cost is not given. Actual variable overheads are not given. Actual fixed overheads are not given. But I'm telling you how you will get actual results. You will always take actual activity level into actual cost of material or actual cost of labor or actual cost of variable overhead or actual cost of fixed overhead. Understood? Okay, or you will multiply with the actual selling price if you want to calculate sales value, like actual activity level into actual selling price. This will give you actual sales. Because in this example, actual material labor variable overhead is not given, actual selling price is not given. So that is why simply I'm just assuming, let's assume actual results at 900 units. For example, our actual sale is 210,000. Actual material cost is, for example, 60,000. Actual labor cost, for example, is 40,000. Actual variable overhead cost is 20,000 and actual fixed cost is 15,000. Let's assume I'm assuming these values, but if per unit is given, you can simply take actual activity level, multiply by actual cost of material, actual cost of labor, actual cost of variable overhead, and actual cost of fixed overhead. Now, so we got it. We have actual sales minus actual cost. We got actual profit. Okay, now guys, please remember, as I told you, if you want to calculate static variance, if you want to calculate, guys, static variance, static. So what I'll do, I'll take the difference of static budget and actual results. Difference of static budget and actual results. Okay, so I'll compare values, these values. For example, here variance is 10,000. It is favorable or unfavorable? I'll explain later. Here variance is also 10,000. Here difference is also 5,000. Here variance is difference is 2,000. Here is the difference is 5,000. Understood? So these are static variance when you compare static budget with the actual results. But what is flexible variance or flexed variance? So in flexed variance, what we will do, guys, we will compare actual results with the flexible value. For example, the difference of these two values, which is 20,000. Difference of these two value, which is 15,000. Difference of these two value, which is, for example, 4,500. Difference of these two value, for example, 1,200. Okay. 20,000 minus 16, no, it is maybe 4,800 or 3,800. The difference of these two value is 5,000. So this is called what is the flexible budget variance. Understood? We have here simple definitions, which I'm going to cover now. I told you these definitions several times, but some new information I will add it here. So I told you what is the static variance. Static variance is what? It is the difference between static budget and actual results. Static budget, you know, we always take budgeted activity level into budgeted cost or budgeted selling price. And actual results, you know, we always take actual activity level into actual cost or actual selling price. This is called static variance. But what is flexible variance? It is the difference between flexible budget and actual results. What is a flexible budget? I told you, you will take actual activity level into budgeted cost or budgeted selling price. But actual results is what? It is the actual activity level into actual cost or actual selling price. This is flexible variance. Okay, if question is silent, mostly in exam, you have to calculate flexible variance. Understood? Okay, that I'll explain what to do. But we have to learn flexible variance. Static way, I told you how you will get it. Then you have here on, now I'm going to tell you, because we have written in the income statement, we have written, sales, and we have written there some cost like cost of material, cost of labor, cost of variable overhead, cost of fixed overhead. And this was the final, it was your profit and loss value when you deduct sales less all cost. Now I'm going to tell you revenue side variance. Revenue side means I'm talking about now sales. Please remember, so variance could be favorable and variance could be unfavorable. Unfavorable variance is also called adverse variance. Adverse. So how would you know it is favorable or unfavorable? Please remember, favorable variance. Favorable means if I'm talking about revenue side, sales, when it is favorable, when it is good for you, when your actual revenue is more than budgeted revenue. So it is favorable. Like your actual sales are more than budgeted. So that is called favorable. So what is unfavorable or adverse? When your actual revenues are less than budgeted revenues. That is called what? Unfavorable. Please remember, whenever variance is favorable, even it is cost side. So if it is favorable, actually it will increase your profit. Due to this variance, your profit is increasing. If your variance, any variance, even it is cost or revenue, if it is unfavorable, it means it is going to decrease your profit. So favorable, why it's called favorable? Favorable because it has positive effect on the profit, because it is going to increase your profit. Why it is called unfavorable? Because it has negative effect on the profit. Then, now I'm going to explain on the cost side variance. Cost side means I'm talking about material variance, labor variance, variable overhead variance, and fixed overhead variance. This is cost side. So when variance is favorable, favorable variance means to say when your actual cost is less than budgeted cost. When your actual cost is less than budgeted cost, this is called favorable, because actual cost is less, it is good. And when variance is unfavorable, when your actual cost exceeds the budgeted cost. Obviously, if your cost is exceeding the budgeted cost, so it is called unfavorable. And please, again, same rule you would say, favorable variance will increase your profit and unfavorable variance or adverse variance will decrease your profit. So this is what is written in the shortcut here. Effect of variances over income or over profit. So favorable variance always increases the profit. Unfavorable variance always decreases the profit. Understood? I hope that is clear. So now guys, here we have one more small concept. So what is the purpose of variance? Like why variance is calculated? What's the reason of it? So purpose of variance is to use the knowledge or is to use the understanding of the variance. When you calculate the variance, so actually we are trying to use the knowledge about variance to promote learning. This is the purpose. Because if variances are unfavorable, we will take some corrective actions to convert the unfavorable variance to the favorable variance. So what is objective? So we want to bring some improvements, continuous improvements continuous improvements in the manufacturing, and we want to learn, okay, what are the reasons of unfavorable variance, because those reasons we need to overcome. If variance is favorable, understood? So that strength we need to continue. Understood? The purpose is what? Is to promote learning and continuous improvements in the manufacturing process. Sometimes they ask you what is the budgeted cost. So this is the definition of budgeted cost. Budgeted cost are expected actual cost. Don't say it's actual. It is expected actual cost. When I say estimate the material cost for the chair, actually what you are estimating, you are trying to expect the actual cost, like what will be the actual cost in future. So that is actually the budgeted cost. Understood, guys? I hope so it is clear. Now, guys, I'm just going to do some couple of questions with you just from the introduction. It was actually the overview of variance analysis. What is the variance? We learned about it. We learned what is the static budget, what is the flexible budget, what is static budget variance, what is flexible budget variance, when variance is favorable, when variance is unfavorable, what is the effect of variance over the profit, and what is the purpose of variance, and what is the budgeted cost. So these things we have discussed so far. So here, don't worry, like don't think this question is really technical. Don't worry, because it's the first question. Various questions are always technical. So let's do the question. So I would request you first read this example, please. I hope so you have read this question. Now let me read it with you guys. Always try to read the requirement first. So they are asking about here, what is the firm's manufacturing cost variance? Please remember, manufacturing cost meant to say all production cost. It will include cost of material, cost of labor, cost of variable overhead, and cost of fixed overhead. Please remember these three costs: material cost, labor cost, and variable overhead cost is called variable cost also. Variable cost of unit. Okay. And this portion is called fixed cost of the unit. Fixed cost of unit. So we have to calculate manufacturing cost, means all cost variance, including material, labor, variable overhead, and fixed overhead, or including variable and fixed cost. Understood? And don't forget the rule. I told you about the fixed cost when you prepare even flexible budget. So fixed cost you will write same as we have written under the static budget. Understood? So here we go. Let me read the question now. We are saying a manufacturing firm planned to manufacture and sells 100,000 units of product. So this is the planned results. It's a budgeted units. During the year, at a variable cost per unit is $4. Variable cost means it includes material, labor, and variable overhead. And fixed cost per unit is $2. It's a fixed cost $2. So variable cost is $4 and fixed cost is $2, which is given. Then a firm fell short of its goal and only manufactured 80,000 units. So this is the actual output. So they produced 80,000 units. They could not produce 100,000 units. So they are able to produce only, or they were able to produce only 80,000 units at a total incurred cost. Total cost means it includes variable also, fixed also. Okay, how much? 515,000. So this is the actual cost. This is the actual cost. Actual activity level is 80,000. Actual cost is 515,000. So now we have to calculate manufacturing cost variance. It's quite easy. When you calculate manufacturing cost variance, I can just write it here. First of all, you have to take, because if question is not specifying is it a static budget or flexible budget, we will always assume it is a flexible budget. So we have to calculate flexible budget variance for the manufacturing cost. Okay, and how you will calculate? You will take first actual total cost. Actual total cost is given. How much? $515,000. This actual cost we will compare with the flexible budgeted cost, which is also called flexed budget cost under British studies. Okay, so how would you know, how would you calculate, for the flexible budget, what is the rule? I told you, you will always pick budgeted activity level into budgeted cost. For example, I'm dealing with the variable cost first. I'll pick budgeted activity level, it was 100,000 units. And budgeted variable cost was $4. So it is going to give you $400,000. Understood? Because 100,000 was the units and $4 the variable cost. Now, if you want to calculate fixed cost, don't forget the rule. Fixed cost you will always write as you have written under static budget. And what was the rule for static? You have to recall the rule. Rule is what you have to take. For static budget, you have to take, guys, I did correctly or incorrectly? I did incorrectly, please. Let me rectify here. Because under flexible budget, so when you will write variable cost, you have to take actual activity level into budgeted cost. And actual activity level is not 100,000, it is 80,000 into 4. So this is not 400,000, this is going to be 320,000. Sorry, it is my mistake. Huh? So for the variable cost, you will take actual activity level into budgeted cost. Now for the fixed cost, you have to write as it is, as you will write under static. And under static, what is the rule you follow? You always follow budgeted activity level into budgeted cost. Because I'm talking about fixed cost, I'll take budgeted activity level was 100,000 and fixed cost per unit was $2. It's given in the question. So this is going to be, fixed cost is going to be 200,000. If I will add total budgeted cost, this is the variable, this is the fixed. So total budgeted cost is going to be $520,000. So what was the actual cost? Actual cost is 515. And what is the budgeted cost? 520,000. So it means budgeted cost are more, or simply whenever actual cost is less than budgeted cost. So this is called favorable variance. And by the way, this is the case here because actual cost is 515,000, but the budgeted cost is 520,000. Okay, so it means variance is 5,000 favorable. But if actual cost are greater than budgeted cost, this variance is called unfavorable for cost side. Understood? But answer here is 5,000 favorable. Is that clear, guys? Which answer you will pick? You will pick your answer. 5,000 favorable. C answer is the correct. Is that clear, guys? Now, guys, we are going to talk about first variance, which is called what? Direct material variance. It is also called direct material cost variance. To understand the variance, guys, you should remember when you write the cost of material into the cost card. Cost card means where you are calculating the cost of the product. So there you will write cost of material. So cost of material, you will also write cost of labor, cost of overheads, variable overheads, and fixed overhead. How do you write material cost into the cost card? So you always take the quantity of material, and you always multiply with the price of the quantity. So you will get what? Material cost. This is how you will write the material cost, like how much quantity you have used, what is the price for that quantity. So you will get the material cost. Please remember variance because it is the difference. So I'm talking about flexible budget variance. Okay. So variance can arise either due to change in quantity. Maybe your actual quantity is different than flexible quantity, or variance can also arise due to change in price. What I said, variance can arise due to change in quantity and or variance can arise due to change in price as well. So that is why there are two types of variance which we have to understand. So direct material flexible budget variance can be divided into material price variance, the variance which will arise due to the change in price, and material quantity variance, the variance which will arise due to change in quantity. So that is why these two variants we have to understand: material price variance and material quantity variance. Okay, if I will take material price variance, plus minus material quantity variance. So this will become total variance of material cost. Total material cost variance. Understood? So now here we go. I'm going to tell you first variance. First we have here, guys, price variance. I will tell you in very simple way. Don't worry. First, I'm going to explain here. Okay. So what is the material price variance? It's very simple idea. So if your actual price is different than budgeted price, if actual price is different than budgeted price is also called standard price. If actual price is different than budgeted price or standard price, so this will give you price variance. The point is that when price variance will be favorable. So obviously, because it's a cost, material cost. So price, if material price, if actual price is less than budgeted price or less than standard price. Actual price, if less than budgeted price or standard price. So this is called favorable. Because actual price is less, because you are buying at cheap prices than planned, it is favorable. But if your actual price is greater than standard price, because I'll use the word now standard price, okay, instead of budgeted price. If actual price is greater than standard price, so this is called what? Unfavorable. Now here, so we have here, I'm going to explain now what could be the causes for favorable price variance or for unfavorable price variance. Don't worry, calculations are going to be very easy. First, let me cover only theoretical points. Okay, so here we go. So there could be two types of price variance. Price variance could be favorable, or price variance could be what? Unfavorable. So when it will be favorable, obviously when actual price paid is less than estimated standard price. So this is called favorable. Why actual price is less? Why? Why you are paying less? So there could be several reasons. Reasons could be positive, reasons could be negative. So why actual price is less? Number one, maybe your purchasing department who is buying the material performed well by finding a lower cost source for the material. Maybe your purchasing department is doing a really good job and they're finding very economical supply from the market or in the market and they're selecting those. Okay, so this could be the reason. Maybe your actual price is less due to the better performance of the purchasing department. Then this could be the first reason. Second reason why actual price is less. Maybe the prices in the industry have fallen. There could be a deflation. Okay, prices are going down. So that is why maybe actual price is less than budgeted price. Okay. Third reason why actual price is less. Maybe purchasing department purchased the lower quality material. See, this could be the reason your actual price is less, but this is the negative reason because they are compromising on quality. So obviously when you buy a B pair product, a B category material, not A category, obviously you would pay less price, right or wrong? So that is why when your purchasing department selects the item with cheap quality, inferior quality, so you would pay obviously lower price for that. So this could be the reason, but this is the negative reason, not the positive. Then why your actual price is less? Maybe the lower, obviously, okay, this is very really important. When your purchasing department buy the lower quality material, obviously your actual price would be less, you are paying less. But look at the fact. What is the effect of low quality material? So lower quality will affect the quantity of material used in the production, because if you will buy lower quality material, maybe your wastage during the production will increase. Right or wrong? On one side you are saving price, but on the other side you are compromising quality and you are increasing wastage of the material. Okay, this is the another reason. Now, price variance can also be unfavorable. This is the second point. Why price variance could be unfavorable? Please remember, whenever your actual price paid, whatever actual price you are going to pay or whatever you have paid, if it is greater than estimated standard price. If actual price is more than budget, obviously this variance is called unfavorable because you are paying more amount. Now you have to think here why actual price is higher. Why higher? So there could be several reasons. The above reasons you can just reverse. The first reasons could be maybe the purchasing department is failed in finding a lower cost source for the material. In simple words, maybe your purchasing department is just sleeping. Whenever you're asking them, please buy material, blindly they are buying. They're not taking quotations properly, etc. So this could be the negligence of purchasing department. That is why you are paying high prices. This could be the reason. Then why your actual price paid is more if price in the industry have risen, like as in Pakistan right now, there is inflation. Even you are very good manager, but every day prices are increasing, so you cannot control. So this could be the reason. Increase in prices in the economy or inflation in the economy could be the reason you are paying actual prices more than estimated standard price. Then why your actual price is higher? Why? Third, maybe purchasing department purchased a high quality material. Maybe you were asking, let's assume purchasing department to buy B quality, B category material, but they have bought for you A category material. And obviously when they will buy high quality, you have to pay high prices. And this is the reason for unfavorable variance, but this reason is having very positive effect over the usage of material in the production. Because when you buy high quality material, so high quality will affect the quantity of material used in the production, because there will be less wastage if you are buying high quality material. Understood? These are theoretical reasons. This, I'm not saying this is the full exhaustive list, but it covers main point. Okay. So now here we go. Now I'm going to talk about quantity variance. Because in the material, there is other variance which is called quantity variance. That I'll tell you how to calculate, don't worry. But here, quantity variance is also called efficiency or usage variance for the material. It measures the difference between quantity means a difference of quantity. So you have to take the difference of actual quantity and standard quantity. That I'll tell you how to calculate, don't worry. Actual quantity and standard quantity. Whenever your actual quantity is more than standard quantity, so this variance is going to be unfavorable because you have used actual quantity more than budget. But whenever your actual quantity is less than standard quantity, so this is going to be favorable because actual quantity you have used less than budget. But the point is that why variance could be unfavorable or favorable. So let's understand first the reasons and then we will move to the calculation part. Okay, please remember guys here, let me tell you, maybe I skipped one point. Price variance is always the responsibility of purchasing department. And quantity variance is always the responsibility of production department. Don't forget. Okay, but you have to look what is the reason. But mainly you should remember overall. Price variance is the responsibility of purchasing department, procurement department, but production variance is the responsibility. Usage variance, quantity variance, efficiency variance is the responsibility of production. Now here we go, guys. Why quantity variance is favorable? Favorable means when actual quantity used is less than standard quantity. Standard quantity means that should have been used. That I'll tell you how to calculate. So for just focus, when your actual quantity is less than standard quantity, so that is called favorable. Now, why actual quantity is less? Why it is less? There could be several reasons. Number one, maybe workers have been efficient by reducing the normal spoilage. Maybe workers are well experienced, so they are not wasting the material. So that is why actual quantity used is less than planned. Number two, why actual quantity is less? Maybe the workers are producing lower quality product. Obviously, when you are compromising on the quality, so waste material you will also paste on the product. So when you produce lower quality product, actual quantity used will be less. Okay. When you are producing lower quality product, it means costs have been reduced at the expense of the product quality. Now we have, on the other hand, we have a favorable quantity variance. Now I'm talking about unfavorable quantity variance. So what is the unfavorable quantity variance? When actual quantity used is greater than standard quantity. Standard quantity means that should have been used. When actual quantity is more than standard quantity. So this is called unfavorable. Why actual quantity is more? Reason, it may indicate theft of material, because sometimes, production labor, they may steal some material from the production. So this will show like that the production department is using more material than planned. This could be the reason, theft. Sometimes maybe the material may shrink. Understood? Then why actual quantity used is more? Maybe the labor is unskilled and they are wasting more material. So they are not using material efficiently. So obviously unskilled labor, they will waste more. So that could lead to increase in actual quantity used. Then why actual quantity used is more? Maybe you can also blame maybe the purchasing department. They are buying cheap material. Cheap material means the material with inferior quality. If they will buy the material with inferior quality, automatically it will increase the wastage and automatically your actual quantity used will be more. So that is why whenever, please remember, purchasing department buy the inferior material, so what will happen? Price variance could be favorable because it is cheaper, it is inferior, it is cheaper, price variance could be favorable, but usage or quantity variance would be unfavorable. So you can also reverse these 2 points. If purchasing department buy high quality material, then price variance will be unfavorable and usage variance will be favorable, just opposite. Understood? Now guys, I'm going to move how to calculate the variance. Is that clear? Theoretical points are clear, guys? Now guys, we are going to talk about how to calculate the material variance. Please remember, actually there are 2 words are there, because I'm just going to tell you how to drive the formula now. Okay, there are 2 words. Words are 2 alphabets, you can say A and S. And we will make 3 combination of these 3 words. And this should be the sequence. Number 1, A times A. Then second line would be A times S. And third combination would be S times S. Please remember here, A stand for actual and S stand for standard. So these are 3 combinations, A times A times S, S times S. But now what you will do with the first column, you will attach the word quantity. For example, actual quantity, and standard quantity. And with the second column, you will attach the word price. Actual price, standard price, standard price. So what are 3 lines? First line is actual quantity, actual price. Second line is actual quantity, standard price. Third line is standard quantity, standard price. First, write these 3 lines. A times A times S, S times S. With the first column, attach the word quantity. With the second column, attach the word price. Now, really important. Once these 3 lines are written, these 3 lines are written here. First line is what? Actual quantity, actual price. Second line is actual quantity times standard price. Third line is standard quantity times standard price. Now the point is that I'll tell you, don't worry. First try to understand how to get actual quantity if it is not given. Sometimes he may give you actual quantity directly in the question. But if actual quantity is not given, so how would you calculate? So you will take actual output, actual production into actual kg per unit. Sometimes he may tell you straight away actual quantity, for example, 5,000 kg. Take it. But if it is not given, you can calculate this way: actual output times actual kg per unit of output. Second, also actual quantity, second column. Same way, actual output into actual kg per unit. Third line is what? Standard quantity. Please remember, this is flexible budget now. And you can say this is the actual budget, actual results. But this is the flexible third line. Third line is what? Third line standard quantity. It's a flexible. Do you remember how flexible budget was calculated? So you will take actual output, which is called actual activity level, into standard kg per unit. Let's say into budgeted data. Okay, this is standard quantity. How you would calculate standard quantity? Actual output into budgeted or standard kg per unit. Understood? And here we have an actual price, most probably will be given. Standard price, most probably will be given. And standard price, most probably will be given. If it is not given, I'll tell you, don't worry how we can calculate. Understood? Let's assume so far it is available. So what I'll do now? So once these three lines are done, written, so what I have to do, I have to multiply actual quantity with actual price. I'll get one answer here. Please remember, once you multiply actual quantity with the actual price, this is also known as actual material cost. Okay, and in your exam question, he may give you this value directly, actual material cost. So you do not need to multiply the actual quantity with the actual price, because actual material cost is given. Just write it. Answer of the first line. Second line is what? You will take actual quantity multiply by standard price. Understood? Then third line, standard quantity multiply by standard price. You will get third line. Okay, please look. Whenever you will take the difference of first two line, which two line? First two, these are the first line answer, this is the second line answer. If you will take the difference of these two lines, it is called price variance. Which variance? Price variance. Look why. See here. Check it there. Is there any change in quantity here? No. Is there any change in price? Yes. So that is why it is a price variance. When you take the difference of second line and third line, okay, this is called quantity variance, which is also called usage variance, which is also called efficiency variance for material. Understood? Why? Look, because the difference of second line and third line is quantity variance. Look, is there change in quantity? Yes, here we are taking actual quantity. Here we're taking standard quantity. But is there any change in price? No. It means that's why it's called quantity variance. Okay. Please, when you compare first two line, this one and this one, this is called price variance. And when you compare second line and third line, this is called quantity variance. Now the point is, variance is favorable or unfavorable, please. When you take actual quantity, actual price, actual quantity, standard price, which is your price variance. This is your price. If the answer of the first line is higher and answer of second line is lower, this variance is always unfavorable. If answer of first line is lower and answer of second line is higher, this is called favorable variance. Why? Because if actual price is more, standard price, budget price is less, obviously it is unfavorable because actually you're paying more. This is the reason. Understood? Same here. What was the second line? Actual quantity. Second line is the same line. I'll paste it here. Actual quantity into standard price. Then what was the third line? Standard quantity into standard price. So if I take the difference of these two lines, this is called your quantity variance. But here, if this line is higher and this is lower, this is going to be unfavorable. And if the first line is lower, second is higher, this is going to be favorable. Is that clear? Okay, guys. Now, one more note you have to remember. If, let's assume, I'm saying calculate price variance, right? First two line, actual quantity actual price, actual quantity, standard price. This is your price variance, right or wrong? But please remember, what about the quantity here? In price variance, you should write it here actual quantity purchased, not used, because sometimes purchased quantity could be different and used quantity could be different. So in price variance, always use actual quantity purchased because it is the responsibility of purchasing department. But when you produce quantity variance, for that you have to write actual quantity into standard price, standard quantity into standard price. Please remember here the quantity should be used quantity, used. Maybe an exam question will tell you company has purchased 1000 kg units, kg material, but they have used 800 kg. In the price variance, you will write it here actual quantity is 1000 kg. But in quantity variance, this actual quantity should be used quantity. This actual quantity should be used quantity, used which is 800. But if in the exam question he told you company has purchased only 1000 kg and no information is given about used, then we will assume here purchases are equal to usage. Okay, understood? Please also remember this thing. Now guys, let me tell you here one more thing. What are the 3 lines I'm writing one more time? The first line was actual quantity into actual price, actual quantity into standard price, standard quantity into standard price. The difference of first 2 lines is price variance. The difference of these 2 lines is called quantity variance. If I will net off the price variance and quantity variance, this is called total variance. Please remember, if in your exam question is asking you to calculate total variance, I do not need to calculate price variance and quantity variance separately. No, I can calculate total variance directly. How? If I take the difference of first line and the difference of last line, look at here, quantity variance is also there, actual quantity and standard quantity. Price variance is also there, actual price and standard price. If I take the difference of first line and the last line, this will give you directly total variance, which will be equal to if you will calculate price variance plus minus quantity variance, whatever answer you will get. So similar answer you can get by taking the difference of first line and the last line. This will give you total variance. And rule is the same. If first line is higher, second line is lower, so variance will be unfavorable. If first line is lower, second is higher, variance will be favorable. Understood? Now I'm going to do one question with you. Try to tackle with me, guys, how we can work with it. Okay, one thing I skipped here. Guys, please remember, because we have used here standard price. In the formula, first line is what? First line is actual quantity into actual price. Second line is actual quantity times standard price. Third line is standard quantity times standard price. Sometime one more trick is there. Sometimes standard price may not be given straight away in the question. Maybe you have to calculate standard price. So then, how would you calculate? So standard price you can calculate. Look at here. If standard price is not given, so you can apply. This is the note. If standard price is not given, so we can calculate by using below 2 formulas. So this would be your first priority if this data is given. If this is not given, then this would be your second priority. Okay. If first data is given, use the first one. If first data is not available, then use the second one. Standard price, how would you calculate if it is not given in the question? Understood? So here we go. For example, standard price. First formula, I can use this one. I can take budgeted or standard material, total material cost. Simply, he will tell you total budgeted material cost, he will tell you. And you will divide here. Divide it with what? With total budgeted quantity. Total budgeted quantity of the material. So this will give you standard price. Like take numerator as total budgeted material cost and denominator as total budgeted quantity. So this will give you standard price. If this is not given, this is also not given, then you should try the second formulas. This data will be given in the question. Number 1, for example, in exam question, he will tell you then usage variance, quantity variance answer he will tell you. Quantity variance, do you remember it was the difference of actual quantity into standard price, standard quantity into standard price. The difference of these two lines is called quantity variance. And if quantity or usage variance is given in dollar, for example, he told you $5,000 minus unfavorable or plus favorable. So you will take this usage variance in dollar, usage variance in dollar. So you will divide with what? Divide with the difference of what? Actual quantity and standard quantity. Do you remember I told you how to get actual quantity and standard quantity? If I take the usage variance, because numerator is a variance, denominator should also be the variance of actual quantity and standard quantity. This will also give you standard price. Clear, guys? So now let's do one question. I hope so. Is that clear, right? Now, guys, here we have a question in front of you. So here every data is given. Just I'm going to complete the format only. Here we go. For example, in this question, what is the data is available? They're saying, let's assume CDINC estimated output for the period of $18,000, 18,000 units. This is estimated output. It's a budgeted output, budgeted quantity. Okay. Or you can say budgeted units, budgeted output, budgeted units, you can use the word. However, actual output was 16,500. This is the actual output. Standard, this is standard direct material per unit was estimated 7.5. This is standard kg. Standard quantity. Okay, standard kg per unit. It's a per unit. Standard quantity per unit. Then what they're saying, but the actual usage is 6.5 per unit. This is the actual kg per unit, 6.5. Standard price was 6.75, but the actual price is 7. So what is the direct material variance? Direct material variance means you have to calculate both price and, let's do, we have to calculate price and quantity both. So how would you do, guys? Very simple. So first you will write actual quantity into actual price. Then second line you will write actual quantity into standard price. Then you will write standard quantity into standard price. 3 lines. Because I'm going to calculate all various price, quantity, and then the total. Actual quantity, how you will take? You will always apply actual output into actual kg per unit. Actual output is given here, look, 16,500. Yeah, 16,500 actual output. And actual kg per unit is, this is the standard. And here is the actual usage was 6.5. So 16,500 into 6.5. This is the actual quantity. Same I will write actual quantity here. Same quantity I will write it here. Okay, and now I want to calculate standard quantity. Standard quantity, do you remember the formula? We will always take actual output into standard kg. Actual output is 16,500, which we have used here also. Here also. Same 16,500, but standard kg I have to pick from the question. Standard kg is standard direct material per unit for estimated 7.5. That I will multiply here 7.5. So 16,500 times 7.5, it is going to give you 123,750 as a standard quantity. And actual price is given in the question as 7. Standard price is given as 6.75. Standard price is also given 6.7. Now what I'll do, what we can do now, guys, if I'll multiply the first line, actual quantity with the actual price, I will get this value. Then actual quantity with the standard price, I'll get this value. Then standard quantity with the standard price, I'll get this value. The difference of first two line is the price variance. The difference of second and third line is called quantity variance. Now point is it favorable or unfavorable? If I'm comparing these two lines, first line is lower or higher? Higher. First is higher, second is lower. So in this scenario, it is going to be unfavorable. I told you, whenever first line is higher, it is going to be unfavorable. Now, when I calculate quantity variance, so I'll compare these two lines. Which two line? this line answer, this line answer. This is going to be my first line. This is going to be my second line now. And first line is higher or lower? No, first is lower, second is higher. In that scenario, variance is going to be favorable. Understood? If I'll take the difference, this is going to be variance favorable. If I will net off these two variance now, this is the price variance unfavorable. This is the quantity variance favorable. If I will net off these two, because one is favorable, second is unfavorable. So my total variance I will get. The total, whatever I will get answer here by comparing these two values. This will be my total variance. So total variance I can calculate this way also by taking the difference of first line and the last line. The difference of first line and last line will be exactly the same as you got the difference between price and unfavorable quantity variance. I hope so it's clear, right guys? Clear? Please confirm through the chat option, guys.